PayPal is generating over 7% free cash flow, buying back billions in stock, and still serves hundreds of millions of users worldwide. Yet the Wall Street seems to have forgotten it. This is a company that was once considered the big tech royalty. Now it trades less than 15 times forward earnings. So has PayPal quietly become one of the best value plays in tech? Or is this just a falling knife with no recovery in sight? Let's find out. Overview. PayPal Holdings, ticker PIPL, is a global leader in digital payments, serving over 400 million active users across more than 200 markets. Founded in '98 and once part of eBay, PayPal has evolved from a basic peer-to-peer transfer platform into a full digital wallet ecosystem. Its family of brands includes Venmo, the peer-to-peer app dominating Gen Z transactions, Braintree, a back-end solution powering companies like Uber and Airbnb, Zoom, focused on international money transfers, and PayPal Credit. It's a buy now, pay later feature competing with Affirm and Klarna. So in summary, they make money by charging merchants a small fee for every transaction and offering value-added services like working capital loans and cross-border transfers. Now let's talk numbers. Financials. Financially, PayPal remains solid, though not without a few red flags. Let's run through the key numbers. EPS is around $5, forward PE is just above 14, no dividend but the company returns cash via aggressive buybacks. Short interest is slightly elevated, market cap stands over 75 billion, 1-year returns around 20%, 5-year returns down by -60%, and 10-year returns only 80%. After peaking above $300 per share in 2021, the stock collapsed, and for the past 3 years it's mostly gone sideways. But the revenue per share tells a different story. PayPal has posted over a decade of uninterrupted growth. EPS and free cash flow has been a bit more volatile, but the trend remains upward. Today the stock offers a free cash flow yield of around 7%, which is quite attractive, especially for a company of this scale. That said, for a tech firm, margins and returns on capital aren't spectacular. These look more like numbers for a mature business. Returns on invested capital currently sits at about 15%. For me, anything between 10 to 15% is decent. Below that, I'll pass. So what we have here is a gas-generating, profitable company trading at a fair price. A shadow of its former growth self, yes, but far from broken. Still, there are a few things that worry me about the future. So where does PayPal go from here? Let's look at the opportunities and risks. Let's start with the opportunities. Digital payment growth. The move towards cashless payments is still going strong, especially in developing countries. This trend will likely continue for a long time and grow the whole digital payments market over time. AI and fraud detection. With huge volumes of user data, PayPal could use AI to build intelligent fraud prevention, improving trust and reducing losses. Venmo monetization. Venmo is wildly popular, but monetizing it more efficiently remains a big untapped opportunity. Share buybacks. With low valuation, PayPal could and is aggressively buying back the stock and rewarding long-term shareholders. Risks. Competition is fierce. Apple Pay, Google Play, Block, and Stripe are all eyeing on the same turf. Here's a list of competitors and their prices. This could set up a price war and margins would go even lower. Innovation fatigue. Some investors question whether PayPal can still innovate, or if it's being outpaced by younger fintechs. Now the biggest red flag is growth. Not revenue growth, but user growth. PayPal's user base is barely expanding. Active accounts grew just 2% year over year in Q2 25, and that's after declining in 23. Total payment volume grew just 5% year over year. Monthly active accounts have been essentially flat, hovering around 220 to 228 million for the past 5 quarters. It's not just the user count. Payment activity is slowing too. In Q2 25, the total number of transactions actually fell 5% year over year. And even transactions excluding PSP partners were flat. The metric they used to brag about, transactions per active account, just dropped by over 4% from previous quarter. That kind of slowdown raises serious questions. Has PayPal reached a ceiling in its core markets? Are users switching to newer platforms like Apple Pay, Cash App or Zelle? And how much longer can a company boost revenue just by raising fees? Unless PayPal finds a way to re-accelerate user and transaction growth, its valuation, no matter how cheap, may remain stuck for a reason. Intrinsic value. Let's talk valuation. PayPal's EPS currently sits at $5.09, and the analysts are projecting solid growth of around 10% per year in the short term. But I'm not fully convinced. With user growth basically flat, PayPal will need to squeeze more revenue out of the same number of people. That means either charging more or increasing transaction volume. Both are tough to do in a highly competitive market. Yes, the overall digital payment space is growing, so there's more cake for everybody. But I still think 10% growth is too optimistic. So for my valuation, I'm using 6% annual growth for the next 5 years, then dropping to 4% for the next 5 years after that. And like always, I want at least 12% return on my money. PayPal's current PE ratio is around 14, a huge drop from its highs nearly 70 a decade ago. Over the past few years, it's mostly traded between 14 and 20, with a 10-year median around 42. Personally, I think PE ratio 14 is still a fair and conservative multiple for the next decade. With these assumptions, I calculate an intrinsic value of around $75 per share. Here's a quick look on how the returns might change depending on your entry price. Just based on numbers, PayPal still looks like a buy. But here's the thing. PayPal feels like one of those companies where execution matters more than the valuation. I don't see a wide moat. I don't see a clear strategic direction. Ask yourself this. If you're making a payment online and PayPal charges $4, while a competitor offers the same service for $1, how long before you switch? Most people don't have a deep brand loyalty to PayPal, and that's the real risk. So while the stock looks relatively cheap, it's going to come down whether the management can actually deliver. So even though on paper it's a buy, I am not buying it. And remember, this is not financial advice and do your own research. But let me know in the comments. Are you buying PayPal, holding or avoiding it? And if you enjoyed this breakdown, don't forget to like and subscribe. See you in the next one, and as always, do not lose money and safe travels. Bye bye.